Welcome back to the channel. Today I'm speaking with Russel Sawatsky at Money Architect Financial Planning based out of London, Ontario. Russel is joining me today to talk about investing for low-income Canadians. Thanks for the time today, Russel.
My pleasure.
Why is it important to save for retirement, even for Canadians who have a low income?
Well, first, I think, Mark, we need to acknowledge that some low-income households may find it impossible to save. So while we can say that it's important to save for retirement, there is a reality out there for some that they will just never be able to do it. Government supports are therefore really their only option. Now, having said that, saving for retirement is important. It's often said that there are three pillars for retirement income in Canada. Pillars like three columns of, well, whatever, marble or wood or whatever you may think of it. Three pillars for retirement income in Canada. Only one of those is the public pension system, consisting of the Canada Pension Plan, Old Age Security, and depending on household income, the Guaranteed Income Supplement. Depending on the province, there may also be some additional support at that level too. The Canada Pension Plan, or CPP, has been long intended to replace about 25% of the income that you earned before retirement. And it's funded by contributions from your income and the matching contributions of your employer. This is now planned to grow to eventually 33.33% over the next decades. But for those who are retiring now or in the next few years, 25% is still the right number to think about, more or less. In other words, you should not expect the CPP to provide full income replacement for you in retirement. In addition, we also have Old Age Security, or OAS, as it's commonly called. This will also help, and it's also available to you from as early as age 65. Now, it's based on your residency in Canada, not your contributions. So it'll be the same amount regardless of your income history. But I would argue that very few people can make a go of it, even with these two sources of income and retirement. The final government support, the Guaranteed Income Supplement, or GIS, is a tax-free benefit explicitly meant to support low-income Canadian residents who are eligible for OAS. Again, it's only available from age 65 on, and you have to be eligible for OAS before you can apply for it. A little bit more on GIS later. So first pillar, government-supported programs. The second pillar is employer-sponsored pensions and retirement savings plans, and they're available at many jobs. However, it's often the case that these programs are less common for those who are employed, say, in minimum wage jobs. If your employer does offer these plans, they can be a significant boost to your retirement savings. That leaves the third pillar, which is your personal saving efforts. Even with the support from government programs and potentially from your employer, a significant responsibility to save for retirement remains with you. This responsibility increases, especially if your employer doesn't provide any support beyond your wages or salary. In sum, across the three pillars of retirement income, personal savings are still important in providing a satisfactory income in retirement.
Russel, can you explain the difference between investing and saving?
They're related, but they are different, I think. We can break it down this way, I believe. Savings is the money you set aside after covering your basic needs like food, clothing, and shelter. It's your first step, your foundation, one might say, toward investing. Because without those savings, without that surplus money, you can't invest. Savings are usually kept in deposit accounts like checking or savings accounts, term deposits, and GICs. These are low-risk options, but they also offer low returns. Now, if you lock away your money in a GIC for more than a year, I would describe you as taking a cautious step into the world of investing. And that's because you are taking a bit of a risk. Now, it's not a risk that you're going to lose your money, but let's use the example of a GIC bought 3 years ago when interest rates were quite low, even for longer-term GICs. Say you bought a GIC with a 2% interest rate back then, 3 years ago, not uncommon. You might have found that to be a good deal at the time, but since then, inflation has risen dramatically, as we all have experienced. In effect, you've lost real value, real purchasing power over the last 3 years because the inflation rate has been higher than your interest rate. And actually, because of that increase in interest and inflation, a GIC today can be bought with an interest rate of over 4%, which might be good if we have decreases in inflation in the future. So it might even be better than you think. But anyway, it can be a bit of a risk in that sense. Investing is typically for the long term. So let's use an example of someone with a newborn. You want to set aside money for their education. You might contribute to a registered education savings plan, an RESP, and invest in a product that could fluctuate, go up and down in the short term, but that has a higher expected return in the long run. And the long run, you have 18 years typically between the time a child is born and they go off to post-secondary education. So that's a reasonably long term. The same goes for retirement. If you're 30 years old, you might have 30 to 40 years until retirement, giving your investments plenty of time to grow. And in theory, you can take the additional risk of higher expected returns, or for higher expected returns, I should say. In summary, savings are for short-term needs, are low risk, and offer low returns. They're usually easily accessible without any loss of income. Investments, on the other hand, are for long-term goals. They have a potential for short-term fluctuations, but also offer the potential for higher expected returns over that longer-term period.
Russell, a lot of people watching may have filled out something called a risk tolerance questionnaire before. They might be familiar with that term. Can you explain the difference between risk tolerance and risk capacity and why they're important for somebody who's on a low income?
Yeah, sure. Risk tolerance, I would describe as more having to do with an individual's emotional or psychological comfort level with the uncertainty and potential loss that might come with a particular investment product or type of products. I can liken it to thrill seekers who love roller coasters with their unpredictable twists and turns. In the investment world, the people who like those sorts of thrills are the investors who willingly take on a portfolio of stocks that zooms up and down, but they believe and have a high probability expectation that while the value might fluctuate dramatically, in the long run, there's a potential for a significant payoff. So that's risk tolerance. I would say risk capacity is more of a practical measure. It's about whether you can physically and financially handle the roller coaster ride. Even if you love the thrill, if your health or your financial situation is at risk, it's better to stay on the ground or at least go on a less rocky roller coaster. In investment terms, someone with a high risk capacity typically has a steady income, substantial financial assets, and the ability to absorb a financial loss from an investment without it drastically affecting their lifestyle. Now, for those with a lower risk capacity, such as individuals with fluctuating incomes or job instability, those might be someone like who's a commission salesperson, or someone who works in a field that often has layoffs and recalls, and sometimes those are, they're not necessarily always consistent. They typically would need to be somewhat more cautious. They would have a lower risk capacity. They can mitigate, lessen that risk through various strategies. One strategy is to have a well-funded emergency fund, a savings account where they can set aside a chunk of money that can help them handle those uncertain times, those financial shocks. The rule of thumb here is to have savings worth 3 to 6 months of your expenses. Another approach is to have a diversified investment portfolio if you do invest. Basically, don't put all your eggs in one basket, but rather spread your investments across a variety of assets so that if one particular sector of the investment world is doing more poorly, hopefully the other side is doing better. And so overall, it's not quite as unstable as someone with a narrower collection of investments. For individuals with a low income, these concepts are particularly important, I think. Their financial safety net may be somewhat limited, so a potential investment loss could have a significant impact on their lifestyle. Therefore, it's crucial to strike a balance between the desire to grow your wealth and the need to create an adequate financial safety net. This might mean opting for lower risk investments or setting aside a portion of income into a savings account or the emergency fund I mentioned before. It's about finding that right balance between risk tolerance and risk capacity. So let's consider a practical example, if I may. Imagine a low-income individual who's managed to save a small amount, but something they want to invest in. Their risk tolerance might be low because they cannot psychologically handle the loss of their hard-earned savings. They might prefer safer investments like a savings account or bonds, which offer lower returns but also lower risk. Now, their risk capacity is also likely low. If they were to lose their investment, they might not have other resources to fall back on, and it could affect their ability to pay for their basic needs. Therefore, it's crucial for them to carefully consider their investment choices, perhaps seeking advice from a financial planner, and to continue building an emergency fund as a safety net. This way they can gradually increase both their risk tolerance and risk capacity over time.
Russell, can you explain what tax-free savings accounts are and why somebody on a low income might favor using a tax-free savings account for their long-term savings?
Yeah, a tax-free savings account, or TFSA, is a Canadian investment vehicle that allows tax-free growth on withdrawals. It was introduced in 2009, and the TFSA has an annual contribution limit. It started at $5,000 back then and has increased over time with inflation, reaching $7,000 as of this year in 2024. If you've been eligible all along from 2009 to now, you have actually a total of $95,000 in contribution room available to you if you've never used it before. Contributions to a TFSA are not tax deductible, unlike with a registered retirement savings plan, or RRSP. However, any growth within the TFSA, whether from interest, dividends, or capital gains, is tax-free. Furthermore, withdrawals can be made at any time without tax consequences. One unique feature of the TFSA is the treatment of withdrawals. An amount withdrawn in a given year is added back to your contribution room the following year. I want to emphasize the following year. For example, if you contributed the maximum amount at the beginning of 2024 and then withdrew $2,500 for an unexpected expense, as long as you wait until next year, until 2025, to put that $2,500 back into your TFSA, it will be added to your contribution room for 2025. So let's imagine if the contribution room in 2025 is $7,500. You, if you've taken out that $2,500 in 2024, can now contribute $10,000, $7,500 of the new contribution room, plus the $2,500 that you're replacing from your withdrawal from 2024. And it will be perfectly acceptable. However, if you recontribute that $2,500 that you withdrew early in 2024, later in the same year, in 2024, it will be seen by the CRA as a new contribution. If you've already maximized your contributions as of 2024, then you are subject to a penalty for over-contributing, 1% per month, to be clear, on the amount of your over-contribution. In other words, it's really important to keep track of your contributions and withdrawal. For low-income Canadians, the TFSA is often a more attractive option than the RRSP. While RRSP contributions provide an upfront tax deduction, this benefit is less significant for those in the lowest tax bracket. For instance, in Ontario in 2024, someone with a taxable income of $50,000 contributing $7,000 to their RRSP would receive a refund of $1,400 based on a combined federal and Ontario tax rate of 20.05%. We can round it to 20%. If your income is in the 29.65% bracket, round it to 30%, you would get a refund of close to $2,100 on that $7,000 contribution. 7,000 times 30% is 2,100. Since retirees are often in lower tax brackets when they enter retirement, PE contributions are more beneficial if your tax bracket is higher in your working years and lower in your retirement years. Another consideration for low-income retirees is that because RRSP withdrawals are taxable, they could negatively affect eligibility for income-tested benefits in retirement, such as the Guaranteed Income Supplement, the GIS. In contrast, the TFSA offers tax-free growth and withdrawals, making it an ideal long-term savings vehicle for those with lower incomes. The flexibility to withdraw and recontribute funds also provides a safety net for unexpected expenses. Therefore, a TFSA can be a really powerful tool for financial planning, regardless of the income level. Remember, it's always important to consider your personal financial situation, though, and the goals you have when choosing between a TFSA and an RSP. If in doubt, I would say, again, consult with a financial planner.
Russell, the world of investing can seem complicated. Even for people who have experience, it can be complicated, but especially for people who are maybe new to the world of investing. What suggestions can you offer to somebody who's looking to get started?
Yeah, totally. Investing can seem really daunting. It doesn't have to be. I'm going to suggest 3 channels to consider for Canadians looking to start their investment journey. First, I'll refer to the advice channel. This involves consulting with licensed professionals who recommend specific investments. The service ranges can start at the high-end wealth management level, where those planners or advisors, wealth management professionals, deal only with people with multiple millions of dollars in investable assets. And it can range down to the mass market options, so the ordinary folks, if you want to put it that way, typically offered by mutual fund sales representatives at local banks or credit unions. Independent financial planners may also be an option. So that's the advice channel. The second option I would suggest considering is the robo-advisor. These services manage your investment portfolio automatically based on a profile that you would have filled out when you logged on and opened the account. It would include a risk tolerance and risk capacity profile questionnaire as well, just to be clear. They often provide mobile apps and web-based access to your accounts. And they're usually much more affordable than the advice channel, although that does depend to some extent. And you don't have to choose the investment. Your profile helps them to make the choice of what to put you into. In that respect, it's a little bit more hands-off, but the most hands-on version, the third channel, is the self-directed or DIY channel. Online brokers, that's what these are, offer this least costly option. However, the representatives you might speak to on the phone or contact through some other online means at some other channel cannot provide advice. They are not licensed to do that. Unfortunately, and I've seen this firsthand as someone who worked in this area in earlier years, that can lead many account holders to treat their accounts as gambling opportunities, or at the other end of the extreme, be way overly conservative and stick all their money into GICs or even savings account type vehicles. So for beginners, I tend to suggest considering some form of advice option. While banks or credit unions may not have the best investment options, they are accessible and they can help you get started. If you can find an independent financial planner who's licensed to recommend investments, that may be a better option. There are also advice-only financial planners who do not recommend specific investments, but can help with asset allocation and can support those who choose the robo-advisor or DIY channels. I want you to remember, though, that a good investment portfolio is not a financial plan. It's important to integrate your investments with financial management of your money, appropriate insurance coverage, tax minimization strategies where they're available to you, and other aspects of your financial life. And lastly, there are many learning opportunities available. The Financial Planning Association of Canada, FPAC, as we call ourselves, for example, offers consumer advocacy and education, including some financial learning opportunities. Many financial planners also offer free or discounted services. And if I can just throw in a little disclaimer, if I may, this information is for educational purposes. I'm not offering specific investment advice. It shouldn't be considered that way.
Thanks so much, Russell. This has been a fantastic discussion. If you like this video, please give it a thumbs up. Consider subscribing to the channel. If you want to get in touch with Russell directly, I'm going to include information on how to get in touch with him in the description section below, as well as information on how to get in touch with the FPAC Pro Bono Committee if you have questions that you'd like us to answer. So thanks again for doing this, Russell. I appreciate it. Thanks for watching, and we'll speak with you soon. Take care.